Good afternoon, everyone, and welcome to our webinar. My name is Jay Boersma, and I'm with Neighborhood Capital Resources. It is early November 2024, and we are in the middle of our next capital raise on our next asset purchase. And we've been getting asked tons of questions by potential partners about cost segregation and depreciation and how that might result in a passive loss for them for 2024. And so we have Kim Lockridge with us from Engineered Tax Services, and we're looking forward to learning how we can benefit from cost segregation studies and accelerated depreciation. Kim is an executive vice president with Engineered Tax Services. Her expertise is valued by many industry professionals in real estate related fields. And also Kim has been a real estate investor for decades. So this is information that it's not just her profession, but she's involved in it personally on a daily basis. So with those things said, Kim, thank you so much for being here, and please take it away.
Thank you, Jane. Thanks, Hannah, for having me. I appreciate the opportunity. So we'll get started on kind of just giving really just laying the groundwork for cost segregation. And we'll talk about kind of what it is, when it's applicable, where it's a good fit, why, and how. Okay, so that's what we're going to be covering today in our presentation. A little bit more about myself. As Jane mentioned, I am the Executive Vice President of Engineered Tax Services. I've been with the firm for about 17 years. I'm also a partner, and I've been investing in real estate since the late 90s. So I have a great portfolio. I've been using and utilizing cost segregation services throughout the majority of my investment career. And I am also on the Tax and Sustainability Committee for the Real Estate Roundtable in Washington, D.C. It's probably it is the largest real estate lobbying group in the country. And so we work very, very hard to pave the way for other real estate investors like yourself. So I appreciate you joining the presentation today, and I'll give you a little bit of background on Engineered Tax Services. Our company has been in business since 2001, so we're on going on our 24th year now, and we run somewhere between 400 and 600 studies a month across the country. That is a lot of property that we're touching. So I wanted to just kind of lay that groundwork with you guys, and billions of dollars in tax savings for our clients. So let's get to the meat of the presentation today and talk about, what is cost segregation? And I've done a few updates to this slide race, so you'll be able to also see what we're talking about here. But essentially, cost segregation is an evaluation for any commercial or investment property to identify and reallocate the difference between real property and personal property. So an investment property is any income producing property. Once you have income on that property, you should be depreciating it. Normally what happens when you have depreciable assets, the real property, it gets depreciated over either 27.5 or 39-year class life. 27.5 is reserved for residential and multifamily. 39-year class life is reserved for commercial and or short-term rentals. Okay, even though short-term rental is a residence or a single family home, it's still depreciated. The IRS views that actually as a commercial property because of its transient nature, like a hotel. And that's why they put that in the 39-year class life. What that means is that property gets depreciated over those years respectively. So if you have $1 million, you depreciate it over 39 years, you get about $25,640 a year in depreciation. Depreciation offsets your income from those properties, and we'll talk about how that could also advance over to like ordinary income. But for right now, essentially what this does is it offsets the income from that property, so you don't have to pay the tax on the income as much as you would if you did not have depreciation. And what we're doing is we're taking this real property and we're segmenting it, hence cost segregation. We're now going to be depreciating assets. We pull out assets from these respective buckets. and we put them into faster class lives, not the whole amount, but portions of them. So there's a 5-year bucket, which is reserved for things like interior finishes or specialty items, carpeting, paint, molding, specialty lighting, specialty electrical, specialty mechanical, those types of things. And then a 15-year class life, which is more focused on exterior site improvements, landscaping, driveways, parking lots, fencing, signage, parking lot lighting, that kind of stuff. So this is more of a 15-year bucket. 5-year bucket is interior finishes. Okay, so what we're doing is we're going to take a part of this asset, and instead of depreciating the whole property over those class lives, we're gonna add a couple extra buckets in there, which reallocates the depreciation. And now you're gonna have all of those buckets here and then one of these. Okay, so visually, this is right here, the whole building. You're treated, when you take that $1 million and depreciate it over 39 years, it's depreciating that asset as a whole. When we do a cost segregation study, what we're doing is we're breaking down those assets into different buckets. So we have fire and protection, electrical, gas distribution, lighting, specialty lighting, escalators, flooring, cabinetry, those types of things, and landscaping. And we break them out into different buckets. As a result of those, each of those assets, as determined by the IRS, they will allow us to put those into the faster buckets. That's where the 5 and 15-year comes in. And so this is where we're coming from at how we're actually breaking this down. Now, some of the questions that come up, like, why would somebody do this? And let me give you an analogy that helps very kind of put this into layman's terms. When you file your taxes, you have a choice, typically. You can file a 1040 EZ and take your standard deductions, or you can file a 1040 and take your itemized deductions. If you don't have kids and you don't own a house, and you don't have investments, and you just have W-2 income or 1099 income, chances are you're probably just going to file a 1040 EZ and take your standard deduction because you don't have any more to itemize. When you start having, own a home, you can deduct your interest. You have children, you get child tax credits. There's all kinds of things that you can do. And so we typically itemize them, and we get more depreciation by itemizing than we would if we did not. And so therefore we use the 1040, okay? And usually you'll have to go get a CPA, and that costs a little bit extra money. But a cost seg study is very much like filing a 1040. You're itemizing. So going back to the previous slide where we had the one building on 39 years or 27 and a half years, that property is straight line depreciation, which is your standard depreciation, standard deduction. So that's like your 1040 EZ. When we do a cost seg study, that's itemizing the building. That's like itemizing our deductions. So hopefully that can help trigger the whys or what we're actually doing with this. We're itemizing the property. And as a result of that, we get accelerated depreciation, right? So instead of depreciating the carpeting over 39 years, which, by the way, I've never seen a carpet last 39 years, okay? The IRS allows us to pop that into a bucket of 5 years. So instead of taking, say, $100,000 of carpeting and depreciating that over 39 years or 27 and a half, we're now going to depreciate the entire $100,000 over 5 years. So you divide it by 5 instead of 39, and you get way more depreciation up front. And it does pay back because, you're going to replace that carpet multiple times through the ownership of that building. And you want to make sure that it's documented correctly on your books, okay? The other interesting fact here is that in the IRS audit technique guidelines, these are the guidelines that the IRS writes for their auditors to audit a tax return that has a cost segregation study. Now they have ATGs for a lot of different things. If there's an ATG, if you're taking the child tax credit, when can you and when can't you, right? There's an ATG for that. So this is an ATG for the cost segregation. And in that ATG, the IRS states that the makers methodology is what we're doing here. The cost segregation is the technical term, is the makers methodology. Once you file under the makers, this is the IRS's preferred method of depreciation. And that's because it's more accurate. So I'll give you an example of the accuracy and why this matters. When you buy a property that's 20 years old, it's new to you. You put it on your depreciation schedule for the date that it becomes placed in service, which is the date you purchased it. And then you depreciate that over the long period of time. And then let's say the building, as I mentioned, is 20 years old, and in year 5, you have to replace the roof. Well, you're already depreciating the roof in the original purchase, and it's all lumped together in that 39-year bucket. When you put on a new roof, the IRS also requires that you capitalize that roof. So you put it back on your depreciation schedule for the cost of that roof, say it's a $100,000 roof. What's interesting about this is that now you're depreciating 2 roofs, one of which does not exist. Okay. So it's not very accurate. And that's why this is the IRS's preferred method of depreciation, is using this maker's methodology, because once you have the value of the roof that we determined in the cost seg study up front, and then you replace the new roof, you can put the new roof on, but essentially you're going to take an expense or a deduction for the remaining depreciation of that old roof, because you don't want that sitting on your books for another, remember, this is year 5. You don't want that sitting on your books for another 34 years when it doesn't even exist. Why not take the write-off now? And so it's much more definitive as to what we're doing with the building, and it describes it a little bit better. So that's why the IRS says that this is the preferred method of depreciation. So also to optimize annual write-offs. What we were just talking about, retirement of assets or demolition, that's what partial asset disposition. It's a disposal of part of your asset. When you're taking off the old roof and you're putting on a new one, you're disposing of a part of your asset. So that's called partial asset disposition. And so when you have a cost segregation study, you actually can be more aggressive in tax deductions, because you have the basis and you understand how much that roof costs. You know how much you can then take off what's remaining. And so it becomes very beneficial moving forward for additional write-offs year over year. It just continues to pay you back. The bonus depreciation, it's a whole nother benefit, a whole nother level to cost segregation. And I'll get into that here on this next slide. Bonus depreciation has actually been around since 2006. It was when it was first enacted. And 2006, it was really specifically more for new construction, and it was only 50%. It wasn't until the Tax Cuts and Jobs Act that Trump gave us, the 2017 Tax Cuts and Jobs Act, where we can expand the bonus depreciation to include purchased property. Prior to that, the 2006 until 2017, it was only for new construction. So they expanded it, saying, actually, we can now take bonus depreciation of purchased properties as well. And they also increased it from 50%, where it used to be, to 100%. Now, what bonus depreciation is remember when I was saying that we're going to reallocate assets instead of everything being in a 39-year bucket, we're going to say 39-year, 5-year, 15-year. Okay. So the 5 and 15-year buckets are class lives. Bonus depreciation applies to any property with a 20-year or less class life. So that means our 5 and 15-year buckets count towards our bonus depreciation. Now, what this means in numbers is that if I buy this $1 million property and I'm able to shift, let's say 30%, okay, as an average, I can shift 30% of that $1 million into 5 and 15-year buckets. Okay, that's the cost segregation study. That's the maker's methodology. we shift those assets to 5 and 15 years, it makes them eligible for bonus. Here's how it works. So if we shift about 30% from the long-term asset into faster buckets that qualify for bonus, that's about $300,000. Of that $300,000, if you had 100% bonus depreciation, as in 2017 through 2022, then that means that you have an immediate tax deduction of $300,000. Now, if you remember in the beginning, I gave you a calculation. If you had $1 million in depreciating over 39 years, your deduction would be about $25,640. Now we replace that. Instead of $25,640, you get a deduction of $300,000. Okay, so I'm giving you an example using the 100% because it's a little bit easier to follow and you can do all of it. So in the Tax Cuts and Jobs Act, as part of that allocation, we had a sunsetting written in that after 2022. Now let me back up for a minute. The bonus depreciation is triggered based on the in-service date. So if you buy a property and it's already producing income, then you would have that in service right away. The place in service date is your purchase price. Okay, so basically whenever it's in service and it's utilized and it's generating revenue. So if you bought a property in 2020, it's in these dates, and you place it in service and it's been on your depreciation schedule, you would be able to go back and be eligible for the 100% bonus depreciation, even if you're doing the cost seg in 2024. So I want to just make sure that that's very clear. If you purchase property and in service between these dates, then you would be eligible for the bonus depreciation likely. Now, if it was purchased and placed in service in 2023, it's going to sunset. We're going to drop to 80%. So that means that in this example of the $300,000 reclassification to 5 and 15-year buckets, you would get about a $240,000 tax deduction instead of the 300. And then 60% this year. So you would get a tax deduction of 180 as immediate tax deduction for those buckets. But here's what's interesting, and this is what I think a lot of people forget or don't realize how it works. When you get, let's call it 180,000 up front, 60% bonus up front, the other 120,000 to make up the 300,000, that gets allocated over its respective 5 and 15-year buckets. So you still get it faster than if you didn't do anything at all. Okay, so that's very helpful. Next year it goes down to 40%, then 20%, and then in 2027 it's scheduled to be gone. Now there is a bill to bring back the 100% bonus depreciation. It passed the House and it was voted down in the Senate. But however, the reasons it was shot down and didn't get approved was because it was coupled with the controversial child tax credit. So we do believe that the 100% bonus will come back, likely after the election, and probably, first quarter, second quarter of next year. This is a bipartisan bill. And again, the only reason it did not get voted in wasn't because of the bonus depreciation, it was because of the package with all the other deals that it was put in with, the other bills. So the bonus depreciation, hopefully that's helpful because it's a very, very, very powerful tool in real estate investing. And I want you to understand that bonus depreciation is on a purchase, a result of doing a cost seg study. You have to be able to shift those assets from the long-term bucket into the shorter-term bucket before you can take the bonus depreciation, okay, on that purchase. Okay, so let's talk about who is a good candidate for cost segregation. So any owner of commercial or investment property. So if it's an income producing property, regardless of whether you're holding it as a partnership, a TIC, or solely owned property, you are eligible for a cost segregation. and it would be at that corporate level likely. Any owner who's paying federal tax or state income tax. Any entity that is operating for profit, right? If you're not profit, this is a tax deduction, and you're not paying tax if you're a nonprofit entity, and so therefore you don't have depreciation the same way. So you're not going to be able to use a tax deduction against that depreciation if you are a nonprofit. Okay. You don't have to own the building. Let's say somebody else owns the building, you are a tenant in the building. Let's say you put $500,000 into building out a dental office, for instance. That would be owned by you, those improvements, if you're paying for them, right? If the landlord gives you a tenant allowance, then they would be paying for it. But if you are paying for it, then you can do a cost study on that. And any owner who's planning to hold an investment property for more than a year. These are really good fact patterns for being able to, at least have a discussion about cost segregation if it's going to work for you. At the syndicated level, like at the GP level, those folks would have the ability to do a cost seg study, and that cost seg study, the results to that would flow through to each of the LP investors at their pro rata percentage of ownership of that property. So they would come through as a loss on the K1. Okay. Even though you may be receiving distributions or checks from those properties of that syndicator, you or the GP, you would then still take losses in accordance with the deductions, even more so than in many cases more so. So you're going to show a negative K1, but you'll still get checks distributed to you. So that's nice. You don't have to pay tax on that. So at Engineered Tax Services, we have a motto, and we believe that everyone should pay tax, but there is nothing in the code that says you have to leave a tip. What's very interesting about cost segregation is that this is a tax code that has been around since the 1940s. This is not new. This kind of hit mainstream, I would say in 2017, 2018, when it started becoming very popular, when it was passed, as an increase that it would cover purchase property. So now everybody and their brother is starting to say, oh my gosh, I can do a cost seg study and get all these huge tax benefits. And everyone thinks it's new. The bonus depreciation, again, is not new. It's been around since 2006. So we're going on almost 20 years. We're 18 years now that we've had some sort of bonus depreciation. And so I just want to highlight that, because I think a lot of people think that this is very aggressive, and that if you take this massive tax deduction that you're going to automatically get audited. And that's just not the case. Okay, this is an automatic change. The IRS gives us all kinds of tools to be able to go back and reconfigure older depreciation and bring in the cost segregation at a later date. And so this is a very, very normal practice, and it's very well known. So let's talk about the types of properties that would benefit from a cost segregation. The first one would be new construction. Anyone who has newly constructed investment property, we can do a cost seg. Renovation to an existing property, that's always a good time to do a cost seg. We would likely suggest that you go back and do a cost seg on the original purchase, and then do the renovations and layer those on top of each other. So essentially you'll be doing two cost seg studies, one a purchase study, one an improvement study. It's going to maximize the benefits for you. Existing properties. So if you've owned a property for 5 years, you can still go back and do a cost seg study on it. The IRS allows us one simple form to make a change that brings it into the current tax year without having to amend your previous return. I think this is very surprising to some people. So if you've owned a property for 10 years, we can still go back and do a cost segregation study. And if it's in the era where we have the bonus depreciation, you can claim the bonus depreciation as well at that time. Any recent or new acquisitions, so new purchases, great time to do a cost seg, especially purchases. And that's because when you buy a property, it's not brand new in many cases, otherwise it'd be new construction. So you're buying a used property. And now we can go in and not only determine the value of each of those assets, but we can also determine the asset condition factor. How old is it? If it's 20 years old and there's only maybe 5 years of life left on that roof, then you don't want to weight the roof value as high because it's not going to last that long. So you want to discount it for that. And we do a condition factor in our reports as well. Leasehold improvements, we talked about this, like with the dental office. Step up in basis. Right now, we have the nation's largest wealth transfer happening as our baby boomers begin to pass away. And this is creating huge inheritances for some people. And those inheritances are a great opportunity because they could potentially pay taxes on that their new basis is going to be stepped up to the fair market value. So regardless of what the purchase price was, they're going to step up into a new basis. And so that's a good time to do a cost seg study. And then 1031 exchanges. If you're doing a 1031 exchange, you sell a property, you buy another property, and then the excess basis or whatever's on top of whatever you rolled in to the gain, that actually goes on top. And you can do a cost seg study on the excess basis. And bonus depreciation also applies. Okay. I'm going to give you an example. I wrote an article, gosh, I think it was like 10 or 12 years ago that was published in Accounting Today. And it was all about the myths of cost segregation, because there are a lot of them. Don't believe everything you hear on the internet, please. This is a very interesting chart because below it shows, this is your straight line depreciation. This is that $1 million over 39 years. You're depreciating it at a rate of, X per year. 25,641 is what it works out to be if you do the math for $1 million. A lot of people would think, hey, if you're going to take your bonus depreciation or your accelerated depreciation, you're not going to have any more depreciation going forward. And that is not entirely accurate. Essentially, you're still going to have depreciation after the cost segregation is done. So the blue line here reflects that you've taken maybe your 5-year bucket. Over that 5-year period of time, you get more depreciation than you would if you didn't do the cost seg study. And then as it drops down, this is the 6 year, right? As the 5-year is exhausted, it only drops just a little bit below that straight line depreciation. It's not as dramatic as people would think. That's the myth. And then even this is the 15-year bucket, and then that gets fully depreciated. And here you have in year 16, it drops again, just a little bit below where it was before. But you get this huge, huge offset up front. Now, I don't know about you guys, but I'm an investor, and I believe a lot of you are there too. And so what we have to think about is what can I do with this tax savings up front? By the time this happens, can I make back the difference? And the answer is yes. It's very powerful of what I can do with these tax deductions up front. Okay. So one example of this in monetary figures, the facts of this particular property was purchased. It was a $500,000 purchase, a very small. $500,000 purchase in 2023. We pulled out 30% for land, which in my opinion is a little bit high. As a national average is about 20%. And this one, because it was placed in service in 23, right? And this was December, mind you. The bonus depreciation eligibility was 80%. So because they purchased this at the end of the year, the very first year, this column right here is a depreciation without a cost seg. So this is your straight line depreciation. So with the 518,000 minus your 30%, land is not depreciable, just so you know. So we can't include the entire 518. We had to pull out 30% for land, set that aside. It's not depreciable. It just sits there on the books as a placeholder. What's left is your depreciation. In this particular case, if you don't do a cost seg study, the first year is always prorated for how many days you owned it. In this case, they owned it for like 1 day. So they had $387 in depreciation. And then every year after that, they'll take about $9,300. Okay, so they see how that goes all the way down to 27.5 or 39 years. When we did the cost seg analysis, the first year tax deduction, because they were at 80% bonus, they got a $76,000 tax deduction in year one. Doesn't matter that they owned it for 1 or 2 days. If it was placed in service and they collected rent, it is in service and they can start depreciating as of that date, and they can take the bonus depreciation up front. Now, they may not have enough income to offset this. Most of my investors don't, especially the first couple of years. They usually eat through it in 2 to 5 years, because let's say there was only $20,000 worth of income. The other $56,000 rolls over and gets added to the 12. So you don't have to use it all, and there's no penalty if you don't use it. It just sits there as a tax asset on your book, and you just eat through it each year. But needless to say, the cost segregation, the $76,000, is the first year tax deduction instead of $387. Very powerful. This, at a 30% tax bracket, essentially, what, $30,000. Okay. I know what I can do with it, $30,000. 25,000, whatever it is. Okay. So, $25,000 cash in my pocket is going to allow me to maybe fund some improvements, maybe hire another employee to help me be more profitable, maybe help me with a down payment on another property, another income producing property. Okay. And then the next year it's 12,000, then 10. And then here is where you finally start to see it flip flop. It's a little bit less than this year, but not much. Remember that last slide where I showed it was just barely below the line? That's these years right here, just barely. And then after the 5 years done, you're exhausted. You're about 7,100. So you're about $2,000 a year less in depreciation than you would have done if you didn't do this. But look how long you have to wait for it. And it just keeps going. Okay. So this one would do very, very well. Some of the detail in the reports, I won't spend too much time on this. The detail on these reports is very helpful. It really breaks down everything. And when I mean everything, I mean every elbow in the plumbing behind the wall. The quantity and the unit price, lineal footage, each count. And we're talking about, custom chandeliers, wall sconces, just a little, everything. This is one page of about 50 in the breakout. Okay, so it's very, very detailed. Now let's talk about how those deductions flow through the tax return individually. We're not going to talk about material participation today because that's really reserved just for short-term rentals, but there are special rules for short-term rentals if you own those. What we're going to talk about today is the real estate professional status and the passive investors. Okay, so real estate professionals, anyone who has established real estate professional status, you have to achieve 750 hours a year in active management for those properties. And it can't be any more hours than, say, a normal job, right? So you have to have more hours than like a W-2 job, for instance, okay, to qualify. And you don't need a license for that. So if you're managing rental property, you could potentially qualify for real estate professional status. If you have a full-time job and maybe your spouse is working part-time or not working at all, your spouse can become the real estate professional status. And then that professional real estate person in your family, you're married filing jointly, so it just offsets your W-2 income. So that's $76,000 in tax deductions. If you're a real estate professional, that goes and offsets $76,000 worth of income. And now you just get an excess of $25,000 back in your tax refund, or minimize it against your tax liability. So it could be very, very, very powerful. The passive investors, let's say you don't have the real estate professional status. Let's say you're a passive investor. Maybe you're an investor at the LP level. as these tax deductions come through to you in your K1, you can use that to offset the income from the property. But if you own other property, you could group those together and use the deductions from a particular syndication or investment to offset some other passive income from somewhere else. So let's say you got a K1 from for $25,000, negative K1. So a loss of $25,000. And you had $25,000 worth of income on another property. You can use that $25,000 to offset that, and you end up paying no tax if you group them together. So just because you're investing in one property that has a loss that comes through the K1, you can offset those. You can group those together. That's called a grouping election. So it becomes very powerful, even for passive investors. Not as powerful as if you are a real estate professional, but for the passive investors, the nice thing about that is at any time that you sell a property or the property gets sold or disposed of, any of those banked up passive losses that you've had that have not used yet, those convert over and offset your W-2 income. So it doesn't just offset the income from the passive investment, but once you sell it, it could offset the income from your W-2. Okay, that's how that works. So I'm going to open it up to some question and answer. I will state my contact information is on the screen if you'd like to reach out. One question I get a lot, and I'll just kind of preface this now, is about recapture. Like when you sell the property, you have to pay back the recapture or the depreciation. The answer, yes and no. Yes, you do have to pay back the recapture. Some of it is usually prorated. So, if you've taken 15 years of depreciation up front, and you sell it in year 5, your 5-year assets are fully depreciated. Your 15-year assets, you've depreciated a third of them, so you're prorated. The other interesting fact is that when you get the tax deductions, it offsets ordinary tax rates, the highest tax bracket. When you sell a property, you're paying it at capital gains rate. So you should already have a 10 to 15% arbitrage in your favor, even if you did this. So the way I look at that is like getting a loan from the IRS and they pay you 10% to take it for however long you own that building. Okay, so it works very, very nicely. So my contact information is on the screen. If you're interested in learning more about cost segregation, or if you're interested in performing a cost segregation study for your properties, you can reach out to me. And if you simply just want, more information, I can direct you for that as well. So
Kim,
Tana
thank
and Jake,
you.
back to you.
Yeah, thank you. I do have a couple questions, just kind of walking backwards in reverse chronology there. And you were talking about the recapture of depreciation, which would create a tax liability. And just to kind of restate in more layman's terms, just to make sure that I understand what you said, when you have that tax liability upon sale, you're going to have a gain. You're going to have cash, and you mentioned there's an arbitrage. So you're going to have more than enough cash to pay your tax liabilities. So depreciation recapture is nothing to fear. Is that fair to say?
Yeah, and if it's a passive investor, it's really not going to impact them. Likely, it's just going to roll forward, continue to roll forward until the property is sold, and then that passive loss is going to offset the recapture anyway. So
And so then
usually it's
another
not really
thing,
a huge factor. And also, if you do a 1031 exchange, you don't pay any recapture because it just rolls over into the new property. So that's important to note too. So you can actually alleviate from paying any of the recapture back by doing a 1031 exchange. I know that might not be the case in a GP-LP situation, but we've seen it happen.
so one of the other last things that you said that I did not know, but when the asset sells, the passive loss that's accrued can then go to offset active income to a limited partner.
Yeah. Yeah, and a lot of people forget, a lot of CPAs forget to check the disposed box, which would create the loss to become active, and they miss it. So just make sure that you know that little rule, so that you can ask your CPA about it if you sell a property, that you can take the losses that are banked.
So it's probably a good time to interject that obviously your CPA is critical in all of this. And so if you are an investor considering an investment, talk to the person who forwarded you this or that you signed up to this webinar through. But also, it's not too early to talk to your CPA and fully understand it from their perspective. I do have one last question, and Kim, we've walked through this via text a few days ago. So hopefully it seemed like it was quick and easy, and obviously we're not going to commit to anything, but going back to your original example with the $1 million property and the $25,000 or $26,000 of depreciation that then becomes $300,000 through a cost seg study. And that was on $1 million property. So in general, if the property were an $8 million property, for example, could you simply multiply that 300,000 times 8 and get a rough rule of thumb for what the total depreciation might be on an $8 million property versus a $1 million property?
Yes, you can, but keep in mind that the bonus depreciation, those figures that I gave you was based on 100% bonus depreciation. So I was going to see if I can share my calculator, but I don't think I can. I don't think you guys can see my calculator, can you?
No.
Okay. Um, so so basically in that case on an $8 million purchase, right? Let's pull out 80% for land. That leaves a depreciable basis of 6.4. Okay, so 6.4 is going to be the number. So then the 100,000 or the million that I was talking about was net of land. So if you're going to buy it for 8 million, you're going to have to pull out land, and now your depreciable asset starts at 6.4. Then your bonus depreciation drops to 60% if it's purchased this year. So 60% of 30%. That means your tax deduction is going to be about 1.1 or 1.2 million, okay, on that $8 million purchase. Whereas if you did that, take the 6.4, divide that by 39, that would have been 164,000. And now you're getting 1.1 million.
And so
So
then if you have capital improvements upon that or on top of that, do the capital improvements get does the application apply in the year that those improvements were done or in the year that the asset goes into service?
if there has not been income generated on the property, then the improvements would get cost segged at the time it goes into service. So it would be when the renovations are completed and you're able to generate income.
Tana, do we have any other questions?
I don't think so.
Kim, this has been excellent. Thank you so much. We'll look forward to talking to you in the very near future to order a few cost seg studies, and we'll look forward to talking to you investors right away also. Thank you so much for being with us. Have a great rest of your day.